Hey everybody, this is Richard. So I'm going to be doing a video here of a trade, covering a trade that occurred on the 23rd of December, which was yesterday. And this was just a real typical day where you had the market open kind of flat, basically break even, and then sort of grind higher, but with a little bit of volatility. And what this is showing though is the options algorithm is loaded on this chart. And so Noble trades the first two trades that this generates every day. Paladin trades all 8 that are potentially triggered. And what we're going to see here in a moment is we're going to see it get into a trade, and it's going to be a bullish trade. So it's going to be a single options trade that it gets into. And on this day, we only had one option trade, so that was really the only trade. But I'll kind of show you it as it occurs here. So the first thing that happens is the algorithm kind of outputs this debug statement that just says it's a high probability that if a certain level is hit or above, then there's a high probability that we'll close above that level, is really what that's doing. And so what you see here though is now it actually did place the options trade. So we ended up doing a put spread, and we sold the 53.85 puts and bought the we sold the 38.55 puts and bought the 38.30. So that's the trade that we made, and when we issued that trade, we collected about 6 points of premium, which is about $300. And what we're doing is we're hoping that the market closes above 38.55, and if it does, then we keep that premium. And these are options that expire the same day. So really, what we're doing is we're just we're kind of waiting for the market to close, and the algorithm expects it to close above that, the short strike, again 38.55. We'll see how the day actually goes, but remember, this is one of the algorithms that's traded, and obviously I have the time is sped up here so that we don't have to wait around too long. Now I know a lot of you are new to options. One thing I want to say is you don't have to understand how options work in order to use the algorithms. This is all done automatically by the broker, so you are able to track it and follow along with the Gain iBroker app, and of course with your statements. But you don't have to understand the details of how these things work. But I wanted to show you just the advantages of put spreads in this video. And so what I have here is a graphic showing the different levels that the S&P would close at and what our profit or loss would be for the day. So the first thing I want to point out is when we do a put spread, we're selling a put, and in this case we sold the 38.55. We're also buying a put at 38.30, and so that creates a 25-point vertical put spread that we're selling in essence. So what we want though is we want the market to either stay at the same level or trade higher. If it closes above 38.55, then we keep the $300 premium that we collected on this trade. And if the market sells off, then we could still be at a gain, depending on how big the sell-off is, but we are capped at a max loss of the premium, or I'm sorry, the spread width minus the premium, which in this case would be the 25 points minus 6, giving you 19 points or $950. So, but let me just talk about the pros and cons of doing these spreads. So the nice thing about them is the market can either go sideways or go higher, and we can still be profitable. In fact, the time that this trade was generated, S&P was trading at 38.55, which means that even if the market drops by a couple points, we're still going to be profitable. In fact, it could go all the way to 38.50 and we would still be profitable on this trade. So we could be wrong on the bullish position and still be profitable. Now, depending on how wrong we are, that's what determines how big the loss is. So if the market were to close at 38.49, we'd be break even. 38.48 would be a $50 loss, and so on until you get to 38.30, where it hits the max loss. So that is one of the other good things about these spreads, is that there is a max loss. We don't have to have a stop, because the bigger, or the most we could lose would be the $950. That means that the market could just get cut in half with an epic crash, and the most we would lose is $950. So that's a good thing. The bad thing is the most we can gain is only $300. So the flip side of that is true as well, that if the market rallied to infinity, we would still only make $300 on the trade. So that's the pros and cons of it. The reason why they're really why the options algorithm uses these is because the algorithm, what it's looking at is not for a big move necessarily. All it's looking at is when you have a certain pattern that occurs, what are the odds that the market closes above the point where it's being examined? And as long as that's 57% or higher, then we will end up doing the trade. And because these spread trades, what they do is they add about 10% to the profitability, which means that on the trades when we place them, it's really about a 70% win rate. But that's really the main thing I wanted to show you with regard to these spread trades, is show you this chart to show you exactly how much we would make depending on where the S&P closes. But I'll speed up the video even more now so that we can see how the day finally closes. So again, you see for this day, I mean, really the market just sort of slowly went higher, and the market ended up closing at about 38.71, which is above that short strike. So this was a full profit for us. So again, we made about $300 per unit traded on both Noble and also Paladin. Now again, this was really just a short video. If you want to know more about Paladin, Noble, and even Geronimo, we have tons of videos on the YouTube channel and on the website that you can watch. But I think that's all I had for today, so I'll end with the risk disclosure again, that past performance is not indicative of future performance. Trading futures and options involves substantial risk of loss, not appropriate for all investors. And keep in mind, I'm not a CTA, I'm a third-party developer, which means that we offer the algorithms to be traded under a letter of direction. These are fully automated trading systems, and if you have more questions, reach out to us. We'd love to answer them, but this is just one of the trades we had. Thank you so much, and have a great day. Bye.